Greetings and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners redomesticate out of volatile legal and tax environments to predictable pro entrepreneurship, pro growth jurisdictions like Florida and Texas. Today, I am reviewing a recent report by Sophia Compton for Fox Business entitled Billionaires and businesses fuel growing exodus from blue states, and we will discuss why this is not a political issue, but instead a practical one. But before we get into that, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business tax and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audits, and of course, the law. My firm website is www.cummings.law. Now, onward. Palantir Technologies moved its headquarters from Denver to Miami. ExxonMobil announced that it will leave New Jersey and reincorporate in Texas. Public Storage is ending a half-century run in California and relocating to Frisco, Texas, a suburb of Dallas. Yamaha is moving its U.S. headquarters from California to Georgia after nearly 5 decades. SpaceX and X, formerly known as Twitter, relocated to Texas. Tesla moved its corporate headquarters from Palo Alto to its Gigafactory in Texas. Chevron announced the relocation of its headquarters from San Ramon, California to Houston. Even Playboy Enterprises moved from Los Angeles to Miami Beach, which is probably a better fit for them anyway. Oracle moved from California to Texas and then from Texas to Nashville. Starbucks is opening a new corporate office in Nashville, and In-N-Out, a California staple, is building a 100,000 square foot Eastern office in that same area. This is not a list compiled over a century or a decade or even a few years. Those are recent moves, and they share a common theme. The destinations are Florida, Texas, Tennessee, and Georgia. The departures are California, the formerly Golden State, New York, New Jersey, Colorado, and Illinois. Since 2020, California, New York, Illinois, New Jersey, and Massachusetts have posted a combined net domestic migration loss of nearly 3.7 million residents, according to the Heritage Foundation, citing Census Bureau data. From July 2024 to July 2025, the top destination states, according to some data, were North Carolina, Texas, South Carolina, Tennessee, Arizona, and Florida. The individual moves are just as informative. Jeff Bezos left Seattle for Miami. Ken Griffin moved Citadel from Chicago to Miami. Howard Schultz, the former Starbucks CEO, moved to Florida after decades in Washington state. Peter Thiel established a new office for Thiel Capital in Miami. Stephen Ross, founder of Related, relocated from New York to Florida. Mark Zuckerberg and Priscilla Chan closed on a Miami area estate. Google co-founder Sergey Brin closed on a $51 million property in northern Miami Beach. The co-founder of Uber moved to Austin, Texas, weeks before California's proposed wealth tax could have reached his estimated $3.6 billion fortune. By one analyst's count, at least 7 billionaires have left California in this wave alone, accounting for $800 to $900 billion in personal wealth. That's almost $1 trillion in personal wealth held by California's approximately 180 to 190 billionaires who have fled the state. The proposed California 2026 ballot measure would impose a one-time 5% tax on individuals worth more than $1 billion. A tax partner at the accounting firm Gersey Schneider stated that the proposed wealth tax is driving high net worth individuals out of the state in volume, and that is exactly what we have seen at my law firm, particularly over the past 5 months. New York City is pursuing its own tax increases under Mayor Mandami, who has proposed raising the top corporate income tax rate from 7.25% to 11.5%. The question for every business owner watching this unfold, this train wreck in slow motion, is not whether the migration is real. It is. Don't take my word for it. Do your own research. Rather, the question is whether you understand the legal mechanism that allows your company to participate in this migration without destroying what you have already built. When a company like ExxonMobil or Palantir announces a headquarters relocation, it is not dissolving its existing entity and forming a new one. That is a common misconception. It is not usually registering as a foreign entity in the new state. It is instead transferring its company domicile through a legal process. For private companies, LLCs, and closely held corporations, as well as many publicly traded companies, that process is called redomestication, and it is the single most efficient method for moving a business from one state to another in almost every case. Redomestication is the legal process of changing the home state of an existing LLC, corporation, or partnership without dissolving the company, without creating a new entity, and without triggering a federal income tax. The company that exists after the redomestication is completed is the same legal entity that existed before. The federal employer identification number does not change. Its contracts remain in full force and effect. Its bank accounts, credit history, and vendor relationships continue without interruption. Under the Federal Internal Revenue Code and applicable Treasury regulations, the redomestication is a non-taxable reorganization at both the entity and owner level when executed in compliance with the statutory requirements of both the departing state and the destination state, as well as the Federal Internal Revenue Code. The redomestication process requires the preparation and execution of a legal plan of conversion, a unanimous written consent or board resolution adopting and ratifying that plan, the filing of articles of formation and conversion with the Secretary of State in the new jurisdiction, and a statement of conversion or equivalent document filed with the departing state after approval by the new state. That sequence and timing is very important. Filing out of order or omitting the legal plan of conversion can result in the inadvertent termination of the company, the creation of a duplicate entity, or the loss of the tax-free characterization of the redomestication. The alternatives, and I hesitate to even use that word, are worse in every measurable dimension for most instances. Foreign entity registration, also referred to as foreign qualification, keeps the company domiciled in the original state and merely registers it to do business in the new state, which means the company must maintain compliance, pay fees, and in most cases pay taxes, and file reports in both states indefinitely and simultaneously. It does not change the company's domicile. It does not eliminate ongoing tax obligations in the former state. It is the wrong tool if the goal is to leave. Now, a traditional merger still makes sense in certain limited cases, but nowadays, in most cases, it is simply not necessary. A traditional merger, in contrast to redomestication, requires forming a new business entity in the destination state and merging the original pre-existing entity into that new entity. The original entity thereby ceases to exist. The surviving entity may require a new federal employer identification number. Contracts will likely require novation or renegotiation if they cannot be assigned. Bank accounts will likely need to be closed and reopened under the federal employer identification number and name of the new entity. Legal fees routinely reach $10,000 or more for a simple merger. Federal tax complexity is substantially higher, and a poorly executed merger can be a taxable event. Good luck cleaning that up. Now, the last option, and it's not really an option at all, but I included in the interest of completeness, is that of dissolution, also referred to as termination. Dissolution kills the company. It is like burning down your house to move to a new neighborhood. The company will no longer exist. If unresolved liabilities surface years later, and they do very frequently, those claims can attach to the owners personally. Dissolution, when performed correctly, is supposed to be a 13-step process that can take 6 months to a year or more. If the owners intended to continue operating, they must then start over with a new entity, a new FEIN, new contracts, and a new credit history. Dissolution is for companies that are truly shutting their doors and going out of business. It is not an effective mechanism to move an existing company to a new jurisdiction. The billionaires and Fortune 500 companies in the headlines have teams of attorneys and accountants executing these transitions. The small and mid-market business owner watching this from a home office in California, New York, or Illinois has the same legal tools available, believe it or not. The statutes do not distinguish between a $900 billion asset manager and a single member LLC. The process is often the same. The requirements are usually the same. The tax treatment is usually the same. The difference is whether you retain an attorney who has done this before or attempt it on your own and discover the consequences 6 months, or in some cases years later, when the IRS sends a nasty letter, or your former state assesses penalties on an entity it still considers to be active. If you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this nuanced process and to schedule time for us to speak about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature. It is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on these topics, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.